If Bitcoin were to crash by 30% in one day, it would send shockwaves through the entire cryptocurrency market, causing a ripple effect across various sectors. The immediate aftermath would be characterized by intense volatility, with prices plunging and leading to significant financial losses for investors. In the short term, panic selling would likely take place as traders and investors react to the sharp decline. Many people may fear further losses, exacerbating the downward momentum and causing additional market sell-offs. Some investors might liquidate their positions to minimize losses, further intensifying the price decline. For retail investors, particularly those who bought Bitcoin during its recent bullish periods, the crash could lead to significant losses and emotional distress. Many may question their investments and seek to exit the market to avoid deeper losses, even if it means realizing a large portion of their capital is wiped out. The crypto exchanges would experience increased trading volume, possibly causing congestion and delays, as many traders rush to adjust their positions. There may also be increased activity and margin calls for those who borrowed funds to leverage their positions in Bitcoin, resulting in forced liquidations. These liquidations could create a feedback loop, exacerbating the downward pressure on Bitcoin's price. In parallel, other cryptocurrencies would likely suffer similar declines, as Bitcoin still holds dominance in the overall market. Altcoins, which often correlate closely with Bitcoin's movements, could experience even greater percentage drops. This would be a critical test for the market as a whole, potentially pushing some lesser-known projects to the brink of collapse. The crash would also attract attention from the traditional financial world. Media outlets would cover the event extensively, and the mainstream would focus on the volatility of Bitcoin. For some investors, it would reinforce the narrative that cryptocurrencies are risky and speculative, potentially damaging Bitcoin's reputation among institutional investors. On a broader scale, a 30% drop in Bitcoin could influence market sentiment regarding other asset classes, particularly if the crash coincides with a time of broader economic uncertainty. Investors might shift their capital away from riskier assets like Bitcoin to safer assets such as gold or government bonds, triggering a broader market decline. Longer-term impacts could include a more cautious approach toward cryptocurrency investments. For those who believe in Bitcoin's potential as a store of value or a hedge against inflation, such a crash might be seen as a temporary setback, with investors re-entering the market once prices stabilize. Others, however, might lose confidence entirely, leading to prolonged periods of lower prices and decreased market activity. In conclusion, a 30% Bitcoin crash in one day would cause massive volatility, widespread panic selling, and could have significant implications for the entire crypto market. The aftermath would likely include financial losses, media scrutiny, and shifting investor sentiment that could either push Bitcoin into a prolonged bear market or set the stage for eventual recovery, depending on how quickly confidence is restored.